Muy buenas, ya estamos de vuelta en Negocios Televisión, seguimos con el mejor análisis, con los mejores invitados y hoy contamos con Martin Moeller, él es Head of Suiza and Global Equities en UBAM y está aquí ya con nosotros. How are you, Martin?
Nice to be here, thank you.
Thanks for coming. For start, I want to ask for your fund, your strategy, and I want you to tell the viewers why do you choose 30 companies? It's really curious.
Yeah, so 30 sounds like a quite concentrated portfolio. So often you find portfolios where people are running 50, 100 stocks in a portfolio, but beyond 30 you don't have a lot of further diversification benefits. So you do an equity portfolio in order to diversify. If you buy, of course, 30 tech stocks or 30 oil stocks, then you're not diversified. But because we try to find something in every sector, we have these 30 companies very different from each other. You get the diversification even with just 30 names. So beyond 30, there's not much diversification benefit, and that's why sticking to 30 that we really know well is our preference.
You are telling that they are different, but what do they have in common? What is the, I don't know, what you look at when you choose a company?
Yeah, what we really like to see is that the company is creating value, and value creation is for us if the cash flow return on investment is better than the cost of capital. So companies that are investing into their factories, into their equipment, they need to make a cash flow on that investment, and that's what we compare. And you find companies that don't need to invest a lot and still have a lot of business, and other companies where it's very capital intensive, you have to have huge factories, but your cash flows might be not so attractive. Over the long term, we find the companies that have good cash flow return investment are outperforming the companies that have lower levels of cash flow return investment. And that's why the focus in the 30 leaders for the companies that have really high levels of cash flow return investment.
So you choose the best, no? The best companies, the best...
Not only the ones with the highest levels, because sometimes these are also the more volatile ones where it's quite uncertain how the future will look like for them. Because remember, the higher these returns, the more it's attractive also for competition to come in and compete these returns away. So we like to have a combination of reasonably high level, but also good visibility going forward. So if we can say where a company is in 5 years' time, in 10 years' time, that's an advantage over something that may be a great opportunity, but there's a lot of uncertainty how this will look like in 5 years' time.
So when you choose a company, that's not in short term, no? You used to look for the future.
Exactly. So really trying to find where are they in 5 years' time, in 10 years' time, with their business model, with their numbers, with their value creation in the sense of cash flow return investment. And you see already during the process of getting these numbers in, is it very difficult? Do I need to make a lot of estimates, or do I have actually a pretty good feeling for it? That you have higher conviction or lower conviction. Think of an energy company that has to invest now. They will start pumping and selling the oil only in 5 years' time. And today I have no idea if the oil price will be at 30 or at 60. At 30 it will probably not be very profitable, but at $60 oil, maybe yes. For me, that's not really an interesting investment because there's too much uncertainty. If I'm thinking of a consumer company, like a L'Oreal, for instance, you have an idea how much the business can grow, what kind of margins they go. In 5 years' time, the company will be not so different than from today. So there I have better visibility, and I would prefer something like this.
And how can we invest in these companies? What can we do?
So really starting with everything that's available in the market, screening for the companies that have already a good history of high levels of cash flow return investment. But then one needs to sit down and really forecast how will it look like in 5 years' time, in 10 years' time, in order to select those that really have this in a sustainable way. So sustainability is not only in the sense of like ESG should be good, there should be not negative surprises from environmental, social, governance factors, but also repeatability of these returns should be enabled actually by the business model, by the attention to ESG, and then you can find a selection of these names that probably will do better than the average company in the market.
I want to ask you about the country. What country is the leader in your portfolio? And for example, what kind of stocks? I don't know, for example, the luxury stocks? Or...
Yes. Yeah, in certain countries, it's easier to find companies that are more value creative, that have higher levels of CFRI. So the US and Switzerland, for instance, are offering a lot of choice there. In Europe, it's a bit more tricky. So the companies tend to be more cyclical. The cash flow return investment in general tends to be lower. Over the long term, we have seen also Europe is underperforming MSCI World. From my point of view, it's because of this reason. There's less value creation in Europe. But even more important than in Europe, to select the interesting companies, like you mentioned, from the sectors that are interesting, like luxury goods, for instance, we find the companies have pricing power, which is important during also inflationary periods, which gives us also visibility that during different market conditions, they can still sell their product. Their client base is also rather resilient. So even during crisis times, these kind of clients keep buying the luxury goods, for instance, while in other segments you see people are trading down and maybe not buying the product anymore. So luxuries, consumer products in general tend to be something that we like for the portfolio. Other sectors like utilities, energy, or the telecom industry is very capital intensive, and there it's harder to find companies that make good cash flow return investment.
Martin, do you have, or are you looking at companies, for example, here in Spain, Spanish stocks, Spanish companies?
Yeah, the stocks that would really best fit this approach of high and stable level of cash flow return investment have been in the past names like an Inditex or like an Amadeus. Amadeus, unfortunately, with the disruptions from the COVID situation, the travel was disrupted, the airlines were disrupted and so on. It has not yet come back to the old levels of profitability that we would like to see. While Inditex, yes, also 2020 had some impact when some of the stores needed to be closed, but the company had a strategy also to sell e-commerce and other sales channels. And with that, they're actually back to the levels from before the crisis and continue to be a rather value creative company.
The last question, Martin, I want to ask you about the profitability of this strategy. For example, we can see this year, for example.
Yeah, I mean, it's really been a successful approach. We launched this in 2010 in different formats and have really been doing better than the overall market. And for this year, with more than 10% performance, again, we would be ahead of the benchmark.
Really good. Martin, thanks for coming here in Negocios Televisión, and thank you for everything, for your questions.
Thanks a lot. Appreciate it. Thank you very much.
Thank you. Pues nada, ya después de esta entrevista ya han visto, sobre todo se fijan en las empresas.